Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending October 12th, 2018. Let's take a quick look. This video shouldn't take long. We'll take a look at the what happened this week and then what to expect going forward. We'll do that. All right, so this is the weekly chart of QQQ, same one I've been showing for a while. And essentially what you see here, you're looking at the span of this entire bull market, and there's been three multi-year trend lines, three multi-year trends that have really defined this bull market with some corrections in between. Now we've had corrections along the way as well, and you can see they're all marked. And those corrections, by the way, I marked. They're marking all the divergent highs. That's what I look for corrections, negative divergence on the weekly chart, and you get these double-digit corrections. They've all ranged from 10 to almost 20%. This says 26, and it did happen in QQQ, but it was a more of a mini crash in the Qs because the Nasdaq 100 didn't fall that much, but most indices fell about 20%. Small caps were down a little more. S&P was just under, and NDX just under the 20% mark. So again, these are corrections that have ranged from 10 to 20. So far, I think we're in for about a 10% or so off the top here. So this one's run of the mill. Certainly has plenty more to go if it wants to do so. And I do maintain that at in the fourth quarter, which we're already in now, I still think we'll see a substantial correction. I'm talking more than 20, more than 10%, quite likely more than 20% is what I think we'll get, at least 20%. But whether it's going to continue next week or not, I'm not certain, and I'll show you why. I'll show you some things I'm looking at. All right, so first things first. So there's all the divergences. This divergent high definitely played out, and you had that, sell signals when we broke this trend line, and then once a SPY followed, and that's what triggered this drop. So you can see just roughly the pop-up box to the left will show you about 10, a little over 10% from the highs to lows over the last 2 weeks, and what makes this one different is from these two that we had before. Somebody mentioned something in the trading room about next week. Well, and my answer was this: back here and here, both on those on the exact days. Yeah, I went long on the site, said I was bullish, looking for a bounce, and I was also short on the highs here, and I put a major sell signal on the U.S. markets back here. It's all on the site. You can go back on the day that markets topped and bottom, and that this one was based on a 60-minute trend line break right here with negative divergence, and so we swung that down, went bullish here, reshorted there, looked for another trend line break. We had another 60-minute divergent high there. We're able to get out, identify the high there, and then the same thing. So these were the two times of the year that I thought were the two of the better buying ops. And what happened there, and again, it's what happened today, is we fell to the 40-week moving average and that long-term multi-year trend line. But what makes it different this time, normally I'd be buying with both fists right here. The reason I'm not now is because of all of this, these big divergent highs, the negative divergence confirmed recently, which makes it this time a little bit different. I'm looking for more downside in the coming months. And so I view trying to game any counter trend bounces beyond what I just did. I knew, I was looking for a bounce, as I stated, a green close yesterday and or today. Well, we didn't get yesterday's green close, but we got it today. And at this point, any more upside I think is probably limited. And because we parked on support, and this is the important thing, and I talked about this the last couple of days, I expected the Qs to regain that level, both the trend line and the 40-week moving average. I use the exponential moving average. A simple moving average comes in right around there right now. So you can look at either one. I just happen to usually prefer the EMAs over the SMAs, but there it is. It's that 40-week moving average does a bang-up job of defining support during uptrends and bull markets on QQQ and stocks like Apple, especially tech companies. And once again, we broke it intra-week. And as I always say, if you're trading on the intra-week or the weekly time frames, all that matters is a weekly candlestick close. It is more than common to see on weekly charts intra-week breaks of trend lines, key moving averages, price levels, and then to see only to see the market regain that level there. So anybody that shorted the break of the 200-day moving average, which is the same if you're on a daily chart, a 200-day moving average is the same as a 40-week moving average. Anybody that shorted that or shorted it because it went on this weekly, well, they were squeezed out today, and they realized not only did they go underwater, but the markets regain that support, and that can be quite bullish. So plain and simply put, As I always say, support is support until and unless broken, and that is why right now I have, and I'm always clear to state my opinion if I have one on the site. Members ask me, or if I do these videos, if I think the market's going somewhere or a particular stock, and I get members ask me all the time, what do you think of this? I have this stock. I'm glad to give an opinion. I'll give a detailed opinion. I'll say I personally would go long here, wouldn't touch it. But if I don't have an opinion, I don't give one, and I'll say I don't have an opinion. And that's what I'm looking at right now. I think it's a crapshoot. I think the odds are, yeah, close to 50-50. I don't want to give an exact number of whether we bounce substantially next week or we continue the selling. We take this level out. Just because they defended it this week doesn't mean it can't go next week. So as you can see, and these lines are so close together. It's a red line here. They're overlapping. We have my trend line and 40-week. And you see we took it out intraday and parked back above it. So there's QQQ back above major support. But it's these divergences that tell me whether we bounce now. Anything is possible. We may bounce. It may be more than just a little bounce. We have plenty of room here. Just so you know, looking at these divergences, plenty of room to push back up. Maybe back test this trend line right here at a higher level, then reverse. And doing so, we could put in another marginal new high, a divergent high still. There's not anything I can see short of a massive blow off top before the end of the year that can negate these divergences. By negating the divergences, I mean burning through them, taking out this prior high right here, because any move on the indicators up to that, any kickback rally that reverses will just simply put in an extension of this divergence high right there. So that's it. And I think the bounce will probably be limited if we even get one next week. But again, I don't, when the odds are nearly equal, if I can't make a clearly bullish or bearish case, I think it's best to stand back. Also, keep in mind, if you're a member of the site and regarding the swing trade ideas that we have, like somebody asked about Nike today, each individual stock or sector should be treated on its own technicals. So if the charts are still bearish there, and nothing's changed in the outlook, you hold on to the trade, give it time to work out again, unless either your stop is taken out or something material changes in the charts and says that, hey, this stock doesn't look so bearish now. In fact, it looks like it might rally. Once in a while, I'll modify my trading plan, pull it in early, even if I'm not stopped out or my target hasn't been hit. But right now, again, there's plenty of stocks that have a lot of technical damage done to them, have already broken down, and are probably headed lower. Just like there's certainly some longs out there that may bounce next week. So I'm going to pour over the charts this weekend, and I'll post any of those on the site that I see that stand out. Now, I just wanted to point this out. So here's a daily chart of QQQ I flipped over. And to go back here, this trend line is that same one that comes off the 2015 lows, and very, very nice fit on QQQ. A lot of reactions. So when I zoom in here, and you can move it around a little because we chopped around through it back in those corrections earlier in the year, but I think this is a pretty good fit. And when I zoom in tight, you can see we bounced off. These are levels I had in place before we came down here. 169.60, we pierced it intraday yesterday, but they parked it right back on there. You can see the body of the candle is on that after that little candlestick wick right there. I'm sorry, the tail or the shadow. The skinny lines are called shadows. Tail above, tail below, wick above. Parked right on there on 169.60 and then bounced right back up. I have a level here around 174.91, give or take, 174.90 we'll call it, right up to that level. So we bounce back, basically it's a bounce back to resistance. And I can say in a vacuum, or this would probably be an objective short entry somewhere where I might have shorted. However, the way I had the trend line drawn on the weekly, that was recovered with QQQ on the weekly basis. So was as you can see here, the 200-day moving average has been recovered. We moved back above it after a brief dip below. SPY as well. So that is why I don't think, although a short here could very well work out, they can also want to pop this market. You may see some more upside today, more people coming in to buy Apple and Amazon now that they think maybe the selling is over for the near term. So I'm just going to wait and see how the charts develop. I can show you levels right here. There it is where we closed today, 178-ish area. And again, I'll get into the charts over the weekend, look at 60-minute charts and outline some specific levels, maybe a zone like I did last week, if you guys remember. And I think I did this for the public viewers too, for the YouTube page. Yeah, here it is. This 15-minute chart. So when we had come down here, I pointed out a bullish divergence here on this 15-minute chart, a downtrend line, a breakout. And last week I said this was my bounce target zone, and that would be a short scaling zone. I expected a bounce to go anywhere from 180.52 up to about 182.65. I said anything above there, I would not continue adding short exposure. And they fell. It shows how weak the bounce was after this bullish, bullish chart pattern divergences, and it was hit the minimum target there, at least my minimum bounce target, and then that's all she wrote. Ran out of gas, and that's it. And then you can see down here on the 15-minute chart, I think this was probably pointed out on the site the other day, we had a little downtrend line wedge type pattern that was a catalyst for today's move. But that's what I'll be looking for and studying for next week. We'll look for these levels for both bounce targets. If you're trading, and quite a few traders on the site went long. We went long to this bounce. I was long to this bounce. Took profits today, but some other traders might have taken things home, and I'll try to identify those levels. I can tell you right now, there's one right there. If we get there, 176.78. That would certainly be an objective short entry. Anything above that, there is a lot of overhead supply in the market, meaning a lot of resistance. So the market has its work cut out for it. I can tell you that. And like I said, I'm leaning towards this bounce either being over anywhere as early as today at the highs, or maybe a little more upside next week if they follow through to today's thing and the fact that the market's held those levels. And if it morphs into something more, so be it. Well, if the charts start to firm up, we might be able to game a bounce into new highs. I'm open to all options, but right now I just can't see it in the charts. Okay, and remember, I don't know if I covered this already. I'm going to move on to SPY, and then we'll wrap this up. These are the three big trend lines. Here's this trend line that we had, very comparable. I pointed that out as far as I'm referring to this trend line I'm highlighting here, is comparable. This one's a little bit longer, but the slopes are nearly identical. You can see they run parallel. The duration, this one was, just roughly, what is that? I'm just curious myself, time-wise, didn't work. Go here to here, and it tells me that was about a 3-year trend line. To the point it was back tested. When it broke, it was about 2.8 years, and then it really picked up here. The Qs were the only ones that touched it there. SPY, NDX, everything else picked up that trend line right here. So that's really that's where we need to measure. And that one just out of for my own curiosity, 2.6 years. So yeah, they're virtually identical trend lines. Now here's what I wanted to get at. Back then, we parked out also. You can see we were testing. And like I've been talking about with the whole nature of a wedge pattern, prices wedge higher and higher with price compression. The bounces are less and less in vigor. And that was happening here. You're compressing. And so we, let's see, zoom in real quick. And you can see right there, we were above the 40-week and trend line. But finally, I'll have to even zoom it a little more. Finally, and I'm going somewhere with this, we broke down with a big red impulsive weekly candle that closed solidly below both that 40-week moving average, which was right here at that part of it in the middle, as well as a downtrend line. And then the next week we had an even bigger drop in the Qs. That was when things really melted down. So we had two horrible back-to-back weeks, and that drop was larger than what we had now. So again, the point I'm trying to make is we are on a very precarious technical posture. We were, it was precarious there. It didn't break, and it led to a rally. So, bulls can defend this level, or it can go next week. That's all I can tell you right now. That's why I'm standing aside. All right, now on to SPY. And you want to see something interesting? Remember how I said SPY they would park the indexes either on those 40-week moving averages or on the trend lines on or thereabout. So here's SPY today. We closed at 275.95, right? So when I put the crosshairs on this candle, you look to the left and see in the red letters, 40 EMA, 275.94. So I missed it by a penny, but close enough. So they parked the SPY right on that 40-week moving average, but it is below pretty decently. It's a pretty decent close below the trend line, so that's something to note. And that's the way I have it drawn. Now you might have an alternative trend line that you can come in on what I call benefit of the doubt trend line. If I capture the bottom of that candle there, let me do this now since I haven't done it yet. We have these other two reactions here, these candlestick the candlestick tails right there. So maybe we draw something like that. Maybe that goes on. I don't like it. I just don't see that fit. I already had a benefit of the doubt trend line there, another trend line. So I just wanted to point that out that we closed right there on the 40-week moving average and a little bit below trend line. So we'll see. Maybe they can rally the markets next week off these EMAs, but if they don't, we probably come down in pretty short order down here to revisit those lows from earlier in the year, and it's about 253.70 on SPY, which would equate to a drop of 841. I'm sorry, about 8.5% or so. 8%, and it'll do one of two things. If a level is watched by so many eyes, you're either going to reverse just shy of it, or you're going to undercut it before reversing. Is it possible to blast right on through there? It depends how you get there. If we're extremely oversold, probably not going to get there and keep going down on through. But I think that's a target a lot of eyes will be watching if, again, these key levels break. So we'll see what happens. We'll see what next week brings. I just think it's probably best if, if you have shorts, and you have a long-term time frame, you want to swing this thing down for the next um, 1 to 3 plus months. I think, and you short it up here. I think you have a great entry. You hold on and let them ride. Unless the charts change or something takes you out, you can lower your stops to break even now and lose nothing, and or you can trail your stops down. So that's SPY on the daily chart. And again, big divergences tell me that sooner or later, and it could be sooner, these levels go, and then ultimately, where you probably want to know where we go over time. Well, from the highs, so well, let me measure it right here. I didn't grab the exact high, but this 211 area, I think we come down there, and we could see that by the end of the year. I know it's closer. We're well into October right now, but like I say, stocks fall a lot faster than they rise. I'm not can't tell you with confidence we'll get there now, but I think at some point by the end of 2019 and probably by the middle of 2019, that's where we'll be, and very likely by even the end of the first quarter. And finally, SPY on the daily chart. You had this divergent high here. You had, zoom in. This is the trend line we were watching recently. This gave us the sell signals recently. We broke trend line number one, fell down, went through the second trend line, had a little hiccup. That's where we flagged a couple days, or that bear flag in the markets came down. Had a pause here around this 279.70ish support level, and now we could probably lower that line down to about this point here. So that's resistance as well if we get up there. But you can see what happened is we had this 270.38 level. I created that back on September 4th. I haven't modified that trend line since, and that support level, and we had a low right around there yesterday. Yeah, 270.36. So I was off by 2 cents on that one. And then we bounced, and you can see we're right on. Again, you can see right on the this candle on that 200-day moving average, but we're below resistance. So the SPY, believe it or not, is even in a more technically precarious position than QQQ. A couple days ago, couldn't say that. SPY started to play catch up to the downside, and that talks a lot. I'm sorry, it says a lot, tells me a lot. In the beginning, this was a tech wreck, and that's all the press was, saying, oh, tech wreck, it's problems with Apple and just, Amazon and those companies. But we started to see some broad-based selling here in the market, and that's the first time in a while we've seen that. Throughout all the corrections we've had in this bull market, there's always been sector rotation. The financials are going down and tech's going up, or tech finally goes down, something else comes up. This was pretty broad based. So there it is, guys. Support zone below, so that's why it doesn't make it so objective. It's especially for new short entries here. But like I said, if you're already short, trail down. Or we can jump in once support levels break. There's two ways to get the next short entry. You either short on bounces back to resistance at objective levels, or you wait for support levels to go. But what you try to do is avoid going long or short in what I call no man's land. No man's land is what I define as when prices are between support and resistance, like right here, for example, where we closed today. Even though there's that moving average, I have support here, I'm sorry, support here, resistance there. So you better to wait to short, at resistance or on a break of support. And this is a support zone, so you really want to see about that 268 level go. If that goes, that'll take out last week's lows. That's not good for SPY. Okay, let's wrap it up here. I'll study the charts over the weekend, and for members, I plan to follow up with some additional analysis on commodities and gold and some other places. We can look to make money, and more importantly, I'm big on diversification and asset allocation. If you're going to trade, don't just trade the markets. Don't just trade one stock. Don't just invest your portfolio in one stock or all U.S. equities. Spread it around. There's always money to make somewhere. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.